Hello students, welcome to another video lecture of Upskilling Commerce. Today we will be discussing auditing in detail. So auditing is the process of examining a company's financial records, transactions and internal controls to ensure they are accurate, reliable and in compliance with accounting standards and legal requirements. It is a key part of the financial reporting process and plays an essential role in maintaining trust in the business world. Audits are usually conducted by independent professionals known as auditors who assess whether the financial statements reflect the true financial position of the organization. Auditing helps in detecting errors, fraud and inefficiencies and also encourages transparency and good governance. In today's complex business environment, understanding auditing is important for commerce students as it develops their ability to think critically, analyze financial data, and evaluate business practices. Auditing plays a vital role in ensuring the accuracy, reliability, and transparency of financial information in any organization. By independently verifying financial records, it helps in detecting and preventing errors, fraud, and misstatements which can harm the company and its stakeholders. Auditing builds trust among investors, creditors, regulators, and the public. It also promotes better internal control systems. It improves compliance with laws and standards and supports informed decision making by management. In a growing economy like India, auditing strengthens corporate governance and contributes to the overall stability of the financial system. Audit is an official inspection of accounts which is done to the first is ascertain the accuracy of financial statements. An audit verifies the accuracy of financial statements by gathering evidence, checking records, and evaluating internal controls. They assess the internal control systems like how payments are approved or how inventory is recorded to see if the processes are reliable and reduce the risk of errors. Auditors vouch transactions by checking supporting documents like invoices, bills, receipts, and bank statements. They may directly confirm balances from banks, customers, or suppliers to ensure the records are not manipulated. Auditors recheck calculations and use sampling techniques to test a portion of transactions that represent the whole. Auditors don't just trust the numbers, they check the truth behind the numbers by testing, matching, and confirming information with documents and independent sources. The next is they certify that there is no misrepresentation of financial information. Auditors check that the financial statements of a business are truthful, complete, and fair. While they cannot guarantee 100% accuracy, they perform a series of professional steps to detect and prevent any material misrepresentations like errors or fraud. Auditors maintain a questioning attitude. They don't blindly trust what management says. They test and verify everything independently. Before starting the audit, auditors analyze areas most likely to be misstated, such as revenue, cash, or inventory. They gather proof by vouching documents like bills, invoices, and contracts, verifying assets physically, confirming balances with banks, suppliers, or customers, and recalculating figures to check mathematical accuracy. They examine the company's systems to see if they are strong enough to prevent fraud or errors. Auditors analyze trends and ratios like comparing this year's profit with last year or industry average to spot unusual changes that may suggest misrepresentation. They review estimates made by management to see if they are reasonable and not used to manipulate profits. Auditors check whether all required information is disclosed properly and that accounting is done as per applicable standards to certify that they comply with both the law and with national accounting standards. Auditors are responsible for checking whether the company's financial statements are not only accurate but also legally compliant and prepared according to national accounting standards. Auditors begin by studying the Companies Act 2013, Income Tax Act, GST laws and applicable Indian accounting standards or generally accepted accounting principles. They also keep track of any amendments or notifications issued by regulatory bodies like the Ministry of Corporate Affairs, ICAI or SEBI. Auditors review the accounting policies used by the company to ensure they are in line with applicable accounting standards and consistently followed from year to year. They check that the format of the financial statements matches legal requirements. They also ensure disclosures are made properly as per accounting standards. For each item, auditors refer to the relevant Ind AS or accounting standard, ensure the company's accounting treatment matches what the standard requires, and check whether classification and measurement rules are followed. Auditors verify if the company has complied with laws like filing returns and reports on time, holding board and shareholder meetings as per the Companies Act, and paying taxes and statutory dues. Now let's move to an important topic, which is books of accounts. So books of accounts are the formal records maintained by a business to systematically record all its financial transactions. These records include the cash book, sales and purchase registers, journal entries, ledgers, and inventory records. Maintaining proper books of accounts is not only essential for tracking income, expenses, assets, and liabilities, but is also a legal requirement under laws like the Companies Act 2013 and Income Tax Act. Accurate books help in preparing financial statements, filing tax returns, conducting audits, and ensuring transparency in business operations. They serve as the foundation for financial reporting and decision making in any organization. Different types of books of accounts are: the first is primary books of accounts. So primary books of accounts are the initial records where all day-to-day financial transactions of a business are first entered before being posted to the ledger. These are also called books of original entry. They serve as the foundation for accurate bookkeeping and financial reporting. Different types of primary books of accounts are: the first is cash book. A cash book is a primary book of account used to record all cash and bank transactions of a business in chronological order. It serves both as a journal and a ledger for cash and bank accounts, meaning transactions entered in the cash book do not need to be recorded again in the journal or posted separately to the ledger. The cash book helps in tracking the cash inflow and outflow, ensuring real-time monitoring of the business's liquidity. It is maintained daily and includes details such as date, amount, account involved, and nature of the transaction. The next is purchase book. The purchase book is a primary book of account used to record all credit purchases of goods meant for resale. It is a subsidiary book of original entry where only credit transactions for inventory or trading goods are recorded. Cash purchases and purchases of fixed assets are not included here. Each entry typically includes the date, supplier's name, invoice number, amount, and a brief description of the goods. Later, totals from the purchase book are posted to the purchase account in the ledger. This helps in keeping purchase records organized and reduces the workload on the main journal. The next is sales book. The sales book is a primary book of account used to record all credit sale of goods that a business deals in. It is a subsidiary book of original entry where each entry includes the date of sale, customer's name, invoice number, amount, and description of goods sold. Cash sales and sale of fixed assets are not recorded here. The sales book helps in maintaining a clear and systematic record of credit sales, and its total is periodically posted to the sales account in the ledger. Since it records transactions directly and in chronological order, it is considered a primary book of account. The next type is secondary book of accounts. Secondary books of accounts are the books where transactions after being initially recorded in the primary books, are classified and summarized under specific account headings. These mainly include ledger accounts, which organize financial data account-wise to facilitate the preparation of the trial balance and final accounts. The most important secondary book is the ledger, where all debit and credit entries from primary books are posted. Special ledgers like the debtors ledger and creditors ledger are also part of secondary books. These books help in tracking the balances of individual accounts and understanding the financial position of the business. Different types of secondary books of accounts are: the first is fixed asset register. A fixed asset register is a secondary book of accounts used to maintain detailed records of all fixed assets owned by a business, such as land, buildings, machinery, vehicles, and equipment. It contains information like the date of purchase, description, cost, location, depreciation charged, useful life, and current book value of each asset. While it is not a primary book, it supports the ledger by providing a comprehensive asset-wise breakdown, which helps in verifying balances, calculating depreciation, and ensuring physical control over assets. It plays a key role during audits and financial reporting. The next is inventory register. An inventory register is a secondary book of accounts used to keep detailed records of a business's stock of goods, including raw materials, work in progress, and finished goods. It tracks the quantity, value, movement, and location of inventory items on a daily or periodic basis. While it does not record financial transactions directly like primary books, but it supports the ledger by helping determine the closing stock value for financial statements and cost accounting. It aids in stock control, reconciliation, and ensures that inventory levels are properly monitored and accounted for. The next is payroll register. A payroll register is a secondary book of accounts that provides a detailed record of all employee salary related information for a specific period. It includes data such as employee names, gross salary deductions, net pay, and payment mode. While it does not serve as a primary book of original entry, it supports the ledger by offering a summary of payroll expenses and liabilities. The payroll register helps in accurately recording salary expenses, ensuring compliance with statutory laws, and preparing audit reports or financial statements related to employee compensation. Auditing is not limited to just examining financial records. There are various types of audit, each serving a specific purpose based on the area being examined. The main objective of any audit is to ensure accuracy, compliance, and transparency in an organization's operations or reporting. Different types of audits are conducted depending on the scope, requirement, and regulatory needs. For example, a statutory audit is mandatory under law for companies, while an internal audit helps management improve internal controls. Other common audits include tax audits, cost audits, and management audits. Understanding these types helps students and professionals know where and how audit principles are applied in real-world scenarios. Let's have a look about various types of audits in detail. The first one is statutory audit. A statutory audit is an audit that is maintained by law for certain types of organizations, especially companies registered under the Companies Act 2013 in India. It involves an independent examination of the financial statements by a qualified chartered accountant to ensure that the books of accounts present a true and fair view of the company's financial position. The purpose of a statutory audit is to check whether the company has maintained proper books of accounts and whether its financial statements comply with the accounting standards, legal requirements, and regulatory guidelines. After the audit, the auditor issues an audit report which becomes part of the company's annual filings with regulatory bodies like the Registrar of Companies. It is compulsory for all companies, including private and public, exceeding specified turnover or capital limits, certain limited liability partnerships, and banking and insurance companies. The next is internal audit. An internal audit is an independent and ongoing evaluation conducted within an organization to assess the effectiveness of internal controls, risk management, and governance processes. Unlike a statutory audit, internal audit is usually not required by law but is conducted voluntarily by management to improve operational efficiency and detect potential issues early. Internal auditors review financial records, compliance with policies, operational procedures, and asset protection methods. They help management ensure that the organization is functioning properly, risks are being managed, and resources are being used efficiently. Internal audits can be done monthly, quarterly, or annually, and the findings are reported to the management or audit committee and not to the external regulators. It is especially important in large organizations, government bodies, and companies with complex operations where regular monitoring is critical. The next is environmental audit. An environmental audit is a type of audit that evaluates how well an organization is complying with environmental laws, regulations, and standards. It involves assessing the company's environmental impact, such as waste management, pollution control, energy use, and natural resource consumption. The goal of an environmental audit is to ensure that the organization is operating in an eco-friendly and legally compliant manner and to identify areas where environmental performance can be improved. These audits help businesses reduce risks related to environmental damage, avoid penalties, and enhance their public image. Environmental audits are especially important in industries like manufacturing, mining, energy, and chemicals where operations can have significant effects on the environment. It may be conducted voluntarily or required by environmental authorities or stakeholders. The next is management audit. A management audit is a systematic and independent evaluation of an organization's management processes, policies, and performance. Unlike financial audits, which focus on numbers, a management audit examines how effectively and efficiently the management team is planning, organizing, directing, and controlling the activities of the business. The purpose is to identify weaknesses in decision making, resource utilization, communication, and internal controls, and to recommend improvements. It helps in improving overall organizational efficiency, aligning activities with strategic goals, and ensuring better governance. Management audits are usually voluntary and conducted by internal or external auditors at the request of top management or the board of directors. They are specially useful for performance benchmarking, business restructuring, or preparing for expansion or mergers. The next is tax audit. A tax audit is an audit conducted to verify the accuracy of a taxpayer's income tax returns and to ensure compliance with the provisions of the Income Tax Act 1961. It is applicable to individuals or businesses whose turnover, sales, or gross receipts exceeds the prescribed limits in a financial year. In India, a tax audit is mandatory under Section 44AB of the Income Tax Act and must be conducted by a chartered accountant. The auditor examines the books of accounts, checks for corrections of income and deductions claimed, and ensures that statutory compliance has been met. The outcome of a tax audit is a detailed report in Form 3CA or 3CB and Form 3CD, which must be submitted along with the income tax return. It helps the income tax department detect underreporting of income, tax evasion, and ensures transparency in financial reporting. The next is cost audit. A cost audit is the verification of cost records and accounts of a company to ensure that the cost of production or services is accurately calculated and complies with the cost accounting standards and regulations. It involves checking whether the cost accounting system is effective, reliable, and helps in cost control and efficiency. In India, cost audits are governed by the Companies Cost Records and Audit Rules 2014 under the Companies Act 2013 and are mandatory for certain industries like manufacturing, energy, cement, steel, pharmaceuticals based on specified turnover limits. A cost auditor, who is usually a cost accountant, prepares a report that includes findings on material costs, labor costs, overhead, and cost allocation. The report is submitted to the Board of Directors and also filed with the Ministry of Corporate Affairs. Cost audits help organizations reduce wastage and inefficiencies, set competitive pricing, improve profitability, and ensure regulatory compliance. The next is compliance audit. A compliance audit is an independent review conducted to determine whether an organization is following laws, regulations, internal policies, and contractual obligations relevant to its operations. The purpose is to ensure that the business complies with statutory requirements, industry standards, and regulatory framework. This type of audit is common in areas like tax compliance, labor laws, environmental regulations, corporate governance, and data protection laws. Compliance audits are often conducted by internal auditors or external consultants, and the findings help management take corrective actions where necessary. Regulatory bodies may also mandate such audits in highly regulated industries like banking, insurance, and pharmaceuticals. By conducting compliance audits, organizations avoid legal penalties, build trust with stakeholders, enhance their corporate reputation, and ensure smooth business operations. And the next is forensic audit. A forensic audit is a specialized audit conducted to investigate and uncover fraud, financial misconduct, or criminal activity within an organization. It involves a deep examination of financial records with the goal of finding evidence that can be used in legal proceedings. Forensic audits go beyond routine checks. They focus on detecting intentional manipulation, embezzlement, bribery, money laundering, or misuse of assets. These audits are usually initiated when there are suspicions of fraud or based on regulatory or court orders. Conducted by trained forensic accountants or auditors, the audit process includes analyzing transactions in detail, tracing suspicious flow of funds, gathering documentary and digital evidence, preparing reports suitable for use in courts or legal investigations, and forensic audits are crucial in cases involving corporate frauds, government corruption, insurance or securities fraud, and dispute resolution. Now let's learn about accounting voucher. An accounting voucher is a documentary proof that supports a business transaction recorded in the books of accounts. It serves as the basis for entries in the accounting system. Vouchers are of two types. The first is supporting vouchers like bills, invoices, and receipts. And the second is source vouchers like internal documents, for example, cash memos, journal vouchers, payment slips, etc. Every voucher should ideally contain date of transaction, amount involved, description and purpose, and signature of the authorized person. These accounting vouchers are used for an audit process which is known as vouching. Vouching is the process of examining documentary evidence, which is vouchers, to verify the authenticity, accuracy, and validity of transactions recorded in the books of accounts. It is considered the backbone of auditing as it helps auditors to confirm whether the transaction actually took place, it is correctly recorded, and it has proper supporting evidence. Vouching helps detect errors, frauds, and fictitious entries, ensuring that the financial statements present a true and fair view. Now let's discuss an example and learn how vouching of sales invoices are done. The first step is to check the invoice number and date. the auditor should first examine whether invoice numbers are sequential and properly documented. Any missing or duplicate invoice numbers could suggest the possibility of unrecorded or fictitious sales. The invoice date must be verified to ensure it aligns with the actual date of dispatch or delivery and sales are recorded in the proper accounting period. Special attention should be paid to invoices dated at the end of the financial year, as incorrect dating may lead to revenue being recorded in the wrong accounting period. The next is to check the customer name and address on the invoice. It is important to confirm that the customer details mentioned on the invoice match the records in the company's customer master file. This helps ensure that the sale is made to a real existing customer and not a fictitious one. Additionally, transactions with related parties like family members, sister concerns, etc. must be identified and checked for proper disclosure and fair pricing. Next is to check the total amount of the invoice. The auditor must ensure that the total invoice amount is correctly calculated based on the quantity and rate. Proper application of discounts, schemes, or rebates should also be verified. Miscalculation can result in revenue understatement or overstatement. So, mathematical accuracy and consistency with supporting documents are essential. Next is to check upon taxes and GST. Each invoice should show the correct application of GST or applicable taxes. The tax should be split into CGST, SGST, or IGST, depending on whether the sale is intrastate or interstate. Also ensure that the GST identification number of both buyer and seller is correctly mentioned. Incorrect GST treatment can lead to tax penalties. Next is authorization. Every invoice should be properly authorized before being recorded. This means it should bear the signature or essentials of an authorized person from the accounts or sales department. In the absence of such approval, the sale may be considered unauthorized. Also, the invoice should be free from any overwriting, alterations, or manual corrections unless properly validated. Next is to check the supporting documents. To validate the invoice, the auditor should cross-verify it with multiple documents. These include the customer's purchase order, the internal sales order, the delivery challan, and transport documents like e-way bill. For cash sales, payment receipts must be examined. This triangulation ensures the transaction is genuine and properly recorded. And the last is to check upon sales returns. If any of the invoiced goods have been returned by the customer, the auditor should confirm that the return is properly recorded through a credit note or return entry. The original invoice should be cross-referenced to ensure that the amount and quantity returned are correctly adjusted in the sales account. Improper or unrecorded returns can overstate revenue and stock balances. Now let's discuss another important audit process which is known as verification. Verification is an audit process that involves checking the accuracy, existence, ownership, valuation, and presentation of assets and liabilities shown in the financial statements. It ensures that the items recorded in the books of accounts actually exist on the date of the balance sheet and are legally owned by the entity and correctly valued in accordance with applicable accounting standards. The auditor examines relevant documents, physically inspects assets where necessary, and confirms balances with third parties to ensure there is no overstatement or understatement. Verification helps in detecting errors, frauds, or misstatements and builds reliability in the financial statements. Now let's discuss an example on verification. Let's learn how verification of a plant and machinery is done by an auditor. Important steps in verification of plant and machinery are: the first is to check existence. The auditor physically inspects the machinery located at the company's factory premises. For example, a machine listed in the fixed asset register is traced to its actual location on the factory floor, the auditor checks the asset number or serial number and ensure it matches the records. If the machine is not found or is non-functional, the auditor will seek clarification or raise a red flag. The next is to check upon ownership. To verify ownership, the auditor examines the purchase invoice or agreement related to the machinery. Suppose the company purchased the machinery from XYZ Engineering Limited. The auditor will have to review the invoice, which should be in the company's name, and also check for payment proof such as a bank statement or payment voucher. If the machinery was acquired through a lease or hire purchase, the agreement terms are reviewed to confirm whether ownership lies with the company. The next is valuation. The auditor checks whether the machinery is recorded in the books at cost minus accumulated depreciation. For example, if the machine was bought for rupees 10 lakh in April 2022 and depreciation of 2 lakh has been charged till March 2024, the net book value should be 8 lakh rupees. The auditor verifies depreciation calculations based on the company's policy, whether they are following written down value method or straight line method, and ensures compliance with the applicable accounting standards. As applicable, they can be either IND AS 16 or AS 10. The next is disclosure. The auditor reviews the financial statements to ensure that plant and machinery are correctly presented under property, plant and equipment in the balance sheet. It should also be supported by proper notes to accounts indicating proper opening and closing balances, additions and disposals during the year, any depreciation charged, and capital work in progress, if any. And the last is additional checks. If the machinery was imported, the auditor verifies the customs duty. The auditor verifies the custom duty payment, freight and insurance costs included in the asset value. If the machinery is mortgaged or hypothecated, proper disclosure under secured loans is required. Now let's talk about qualifications of an auditor in India. To be appointed as a statutory auditor of a company under the Companies Act 2013, an individual must possess the qualifications which I am discussing in detail. The first is membership of ICAI. The auditor must be a chartered accountant and a member of the Institute of Chartered Accountants of India. Only individuals or firms qualified as CAs under the Chartered Accountants Act 1949 can conduct audit of companies. The next is a firm of chartered accountants. So a firm including limited liability partnerships can be appointed as an auditor if the majority of its partners practicing in India are qualified chartered accountants. Eligibility under Companies Act. So the individual or firm should not be disqualified. Under Section 141, Subsection 3 of the Companies Act 2013, the auditor must hold a valid certificate of practice issued by ICAI, which authorizes them to engage in audit and other professional services. While not a legal requirement, auditors are expected to have a strong understanding of accounting standards, auditing standards, legal compliance, and industry practices, making practical experience essential. These qualifications ensure that the auditor is professionally competent, independent, and ethically responsible to perform audit duties in accordance with the law and auditing standards. Now let's talk about duties of a company auditor. A company auditor plays a critical role in ensuring the accuracy, reliability, and transparency of a company's financial statements. Now let's discuss about the key duties. The first is examining financial records. It is one of the core duties of a company auditor and forms the foundation of the audit process. The auditor is responsible for thoroughly reviewing the company's books of accounts, vouchers, supporting documents, and financial statements to assess whether they have been maintained in accordance with the provisions of the Companies Act 2013 and applicable accounting standards. This includes checking transactions recorded in the journal, ledger, cash book, purchase and sale registers, and verifying balances in the trial balance. The auditor ensures that all material entries are properly documented, supported by valid evidence, and accurately reflected in the financial statements. By doing so, the auditor can form an independent opinion on whether the financial statements present a true and fair view of the company's financial position and performance, which is ultimately reported to the shareholders. The next is reporting to shareholders. So, after examining the company's financial statements, the auditor must prepare an audit report and submit it to the company's members who are shareholders. This report must state whether the financial statements comprising the balance sheet, profit and loss account, cash flow statement, and notes to accounts give a true and fair view of the company's financial position and results of operations. The report should also confirm compliance with accounting standards, disclosure requirements, and relevant legal provisions. If there are any qualifications, adverse remarks, or reservations, these must be clearly stated along with their reasons. This duty ensures transparency and accountability, enabling shareholders to make informed decisions based on reliable and independently verified financial information. The next is compliance verification. This involves examination of whether the company has followed all applicable laws, rules, regulations, and accounting standards during the preparation of its financial statements. The auditor checks compliance with the provisions of the Companies Act 2013, including maintenance of books of accounts, statutory filings, adherence to board resolutions, and proper disclosures. Additionally, the auditor verifies whether the company has complied with applicable tax laws, GST regulations, labor laws, and industry-specific rules. The auditor also ensures that the financial statements conform to the prescribed accounting standards. The auditor also ensures that the financial statements comply with the accounting standards and transactions are recorded and presented fairly. Any instance of non-compliance must be reported in the audit report along with its potential impact on the financial position of the company. This verification safeguards stakeholders by ensuring the company operates within the legal and regulatory framework. The next is assessing internal controls. Assessing internal controls is a vital responsibility of a company auditor, which aims at evaluating the effectiveness of the company's systems and procedures designed to ensure accurate financial reporting, safeguard assets, and ensure compliance with laws and policies. The auditor examines the company's internal financial controls such as authorization procedures, segregation of duties, approval hierarchies, and checks on cash and inventory handling. For specified class of companies like listed entities, auditors are required as per the Companies Act 2013 to express an opinion on the adequacy and operating effectiveness of internal financial controls over financial reporting. Weaknesses in internal controls may lead to errors, fraud, or misstatements in financial records. If deficiencies are found, the auditor must report them along with recommendations for improvement. This assessment strengthens the reliability of financial statements and promotes better corporate governance. The next point is detection of frauds and errors. During the audit process, the auditor must apply professional skepticism and use appropriate audit procedures to identify any material misstatements in the financial statements, whether caused by fraud or errors. This includes examining unusual transactions, inconsistencies in records, missing documents, or irregular patterns in financial data. If the auditor comes across any suspicious activities like manipulation of accounts, fictitious entries, or unauthorized payments, they must investigate further and report the findings. As per Companies Act 2013, if an auditor detects a fraud involving a specified amount, currently which is 1 crore or more, they are required to report it to the central government, while smaller frauds must be reported to the company's board or audit committee. By detecting and reporting frauds and errors, the auditor helps protect stakeholders' interests and reinforces trust in the company's financial reporting. And the next is communication with board. This is to ensure that significant audit findings, concerns, and recommendations are brought to the attention of those charged with governance. During the course of the audit, the auditor is required to maintain open, timely, and transparent communication with the board or the audit committee, especially in areas involving internal control weaknesses, material misstatements, non-compliance with laws, or suspected frauds. This may include formal discussions or written communications on matters such as accounting policies, estimates, related party transactions, going concern issues, and audit adjustments. Effective communication with the board helps in strengthening internal controls, resolving audit issues promptly, and ensuring the company operates with greater transparency and accountability. Now let's discuss about another important aspect in audit, which is audit report. So an audit report is the formal written opinion issued by an auditor after examining a company's financial statements. It is the final product of the audit process and provides stakeholders such as shareholders, regulators, and investors with an independent assessment of whether the financial statements present a true and fair view of the company's financial position and performance in accordance with applicable accounting standards and legal requirements. Audit reports can be of two types. The first is a qualified opinion. Auditors can issue two different types of opinions through an audit report. The first type is qualified opinion. A qualified opinion is issued by an auditor when the financial statements are mostly accurate and fairly presented, but there exists a specific area of exception that is material but not persuasive to the overall financial statements. In simpler terms, the auditor believes that except for one or more particular issues, the financial statements give a true and fair view. Some examples of this situation can be like inventory was not physically verified at year end, or a specific expense was not accounted for in accordance with applicable accounting standards. There can also be an inadequate disclosure about a contingent liability. A qualified opinion alerts users that while the financial statements are generally reliable, caution should be exercised in interpreting the areas of concern. It helps maintain transparency without undermining the entire financial report. The next type of opinion is unqualified opinion. An unqualified opinion, also known as a clean opinion, is the best type of audit opinion an auditor can give. It means that in the auditor's professional judgment, the company's financial statements present a true and fair view of its financial position and performance in accordance with the applicable financial reporting framework, and that there are no material misstatements or non-compliance issues. Key features of an unqualified opinion are: the financial statements are free from material errors, fraud, or omissions. The company has followed appropriate accounting policies and standards. There are no significant disagreements between the auditor and management. Internal controls are functioning adequately. An unqualified opinion builds trust among shareholders, investors, lenders, and regulators, as it confirms the credibility and reliability of the financial information provided by the company. It reflects positively on the company's financial reporting and internal control environment. Now let's talk about different softwares that are used in audit. The first one is Microsoft Excel. So it is an essential tool used throughout the audit process for planning, executing, and reporting. It is used to prepare audit programs and do calculations. It helps import and analyze client data such as ledgers, trial balances, and bank statements. Excel is also critical for recalculating figures like interest or depreciation, conducting reconciliation, and performing analytical procedures such as trend and ratio analysis. Excel enhances accuracy, efficiency, and documentation throughout the audit process. The next is SAP, Oracle, or Microsoft Dynamics. So ERP softwares like SAP, Oracle, and Microsoft Dynamics are primarily used to extract, review, and verify financial data during an audit. These systems serve as the central source of truth for a company's transactions. So, your first step would be to obtain general ledgers, trial balances, journal entries, and supporting documents. Built-in reports are used to perform ledger scrutiny, verify transactions, and check audit trails that show who made changes and when. In SAP or Oracle, you can track document flow from purchase orders to payments, helping you perform vouching and trace transactions across modules. Additionally, these systems support the review of internal controls such as user access rights, approval workflows, and segregation of duties. The next is Tally Prime. Small and medium-sized businesses commonly use this software for accounting. Tally Prime provides easy access to the company's financial data, including ledgers, vouchers, trial balances, and financial statements. It allows you to scrutinize ledgers, filter transactions by amount or date, and detect inconsistencies or unusual patterns. You can verify GST returns, TDS reports, and statutory compliance directly from the system. Tally also enables you to check the inventory records, reconcile bank statements, and cross-verify transactions against supporting documents. The software supports exporting data to Excel, making it easier for you to conduct ratio analysis or sampling. And the last is QuickBooks or Zoho Books. They both are cloud-based accounting softwares primarily to review, verify, and analyze financial data of small to mid-sized businesses. These tools offer real-time access to the client's financial records, including general ledgers, trial balances, invoices, bank transactions, and tax reports. In QuickBooks, one can track changes made to entries, verify bank reconciliations, and review sales, expenses, and payroll details. Zoho Books provides similar features, including access to GST reports, compliance tracking, and automated workflows, helping auditors test internal controls and trace transactions. So that's all for auditing. We will meet in another video of Upskilling Commerce with a new topic.